As a loan officer, I understand that navigating the world of mortgage interest rates can be daunting, especially for first-time homebuyers. However, understanding these rates is crucial for making informed decisions about one of the most significant financial commitments in your life. In this video, we'll explore the fundamentals of mortgage interest rates, including the difference between float and lock, interest rate versus APR, and the distinction between fixed and adjustable rates. So what are mortgage interest rates? Simply put, a mortgage interest rate is the rate at which a lender charges you interest on the money that you borrow to buy a home. It's essentially the cost of borrowing money, expressed as a percentage of the total loan amount. This rate determines the amount of your monthly mortgage payment and the total amount of interest that you'll pay over the life of the loan. Example, a $100,000 loan at 5% interest is going to be $5,000 a year. What's the rate? I get calls every single day asking this question. So what are interest rates right now? It's just not that simple. There are so many things that affect interest rates, and your interest rate is going to be specific not just to the rate environment, but to you and even to the property that you're choosing. Let's talk about it. What are the factors that influence mortgage interest rates? Number one, economic conditions. The overall state of the economy, including factors like inflation, unemployment rates, and economic growth, can significantly impact mortgage interest rates. In times of economic expansion, interest rates tend to rise, while they typically fall during economic downturns. Any instability can affect interest rates, though, even consumer confidence, political swings. One thing professionals use to gauge tendencies on what may happen is the bond market and mortgage-backed securities. While it's not a crystal ball, oh, how I wish I had one of those. There is historical evidence of how mortgage rates tend to move in tandem with these. So a lot of professionals will watch the bond market, myself included. Number two, Federal Reserve policies. The Fed and the central banking system of the United States plays a crucial role in influencing mortgage rates through its monetary policy decisions. The Fed's actions, such as adjusting the federal funds rate or implementing quantitative easing measures, can directly affect interest rates. Number three, your credit score and debt-to-income ratio. Your credit score is a major determinant of the interest rate that you'll be offered. Lenders use your credit score to assess your creditworthiness and the risk of default on the loan. Generally, borrowers with higher credit scores are eligible for lower interest rates as they are perceived as less risky to lenders. What is more, the debt-to-income ratio on this loan can increase a risk when it's higher and decrease risk when it's lower, which can also impact your rate. Number four, the loan term. The term of your loan, i.e. the length of time you have to repay it, also influences the interest rate. Typically, a shorter term loan, such as 15-year mortgage, may have a lower interest rate compared to a longer term, like 30-year mortgage. That said, though, strategically, the 30-year rate, while higher, will have a lower payment. So many times I'll compare the 15 to the 30 and suggest making the payment required on the 15 but lock the 30-year rate, so all that extra money goes towards principal, essentially making that portion of each payment interest-free. We just need to do the math on your scenario and find out what's the best term and strategy. Number five, down payment and loan amount. The amount of money that you put down as a down payment can impact your interest rate. A larger down payment often translates to a lower interest rate, as it reduces the lender's risk and demonstrates your financial stability. The amount of the loan can also impact the score. Again, it's all about risk versus reward for the investor. Sometimes a larger loan amount with good debt-to-income ratios, insignificant down payment, or reserves can get a better rate than a smaller loan amount. The reverse can also be true, however. If you are pushing the limits, you'll likely get a higher rate than if you were to go with a smaller loan amount and more margin in your debt to income ratios. Number 6, the property. The property type and occupancy status will also affect the interest rate that you get. If you're looking at a manufactured home versus single family home, your rate is going to be a touch higher. The rate for primary residence is always going to be lower than for second home or investment property, so property matters. So now that you know what goes into your rate and you understand that rates are fluctuating every day and many times, several times a day, a lender that quotes a rate without a full application, they're just guessing. So we don't do that. We'll give you a rate range, which can give a best and worst case scenario for today and a ballpark to work within. But until we have the home, a full application, and we lock that rate, we are really just giving you an educated guess. It's not all about the rate either. We'll get more into that as I explain some of our other terms. But strategy is so important. Now let's talk about some of the types of mortgage interest rates. Fixed rate mortgage. With a fixed rate mortgage, the interest rate remains constant throughout the entire term of the loan. This provides borrowers with predictability and stability as their monthly payments remain always unchanged on the principal, regardless of fluctuations in the broader economy. You set it and forget it, basically. So it's always something that you can refinance if a better rate comes along, but a fixed rate can be more usable. An adjustable rate mortgage, also called an ARM, features an interest rate that can fluctuate periodically based on market conditions. Initially, ARMs typically offer lower interest rates compared to fixed rate mortgages, but they come with the risk of rate adjustments in the future, potentially leading to higher payments. So a loan that would have a 3% rate today might keep that same rate for 3 years or whatever the term of adjustment takes. Those can vary, but on the 4th year it could jump up to a higher rate, again depending on the terms of the adjustment. So these can be a great option for someone who needs a short-term plan, but if rates are low or this is your forever home, I would suggest looking at the fixed rate option. What about a float rate versus a locked rate? A float rate, also known as a floating rate or floating interest rate, is an interest rate that is not locked in. During the mortgage application process, borrowers may have the option to float their rate, allowing it to fluctuate with the market until they decide to lock. Do not confuse a floated rate, which just means it's not locked yet, with an adjustable rate that we just discussed. The adjustable rate varies and adjusts. The float rate just floats, it's not locked. A locked rate is when we lock in the loan interest rate for a set amount of time. It might be 15 days, 30 days, 45, etc. This gives peace of mind and predictability to the borrower because they know that their rate is not going to change before they can get the loan closed. Okay, now that we've talked about the types of rates and whether to float or lock the rate, now let's discuss the difference between interest rate and APR. Interest rate is often referred to simply as the rate. That is the percentage of the loan amount that a lender charges as interest. We talked about that earlier. This rate determines the amount of your monthly mortgage payment and the total amount of interest that you'll pay over the life of the loan. It does not include fees, charges, or anything associated with the loan amount. Percentage rate is the annual percentage rate, or APR. It's a broader measure of the cost of borrowing money that includes not just the rate, but also the fees and charges associated with the loan, such as origination fees, points, closing costs. The APR provides borrowers with a more comprehensive understanding of the total cost of the loan and can be helpful for comparing different loan offers. Now let's talk about points versus credits. Look at this chart. Par means 0 on the chart. So if you have points, then it's going to be above 0. There is a charge there. If it's credits, then it's below 0, and you can get credits for that rate. You can pay a little bit more for a better rate, Or if you're short closing costs, you might want to lock in at a rate that is a touch higher to receive those credits toward your closing costs. Mortgage discount points are upfront fees paid to the lender at closing in exchange for a lower interest rate. Each point typically costs 1% of the loan amount and can reduce the interest rate by just a fraction of a percentage point. Here's how they work. If we have the purchase price minus down payment, that's the loan amount. So if we have $120,000 minus $20,000, our purchase price is $100,000, correct? So 1% of that is $1,000. The benefit of paying points up front can lower your monthly payment and total interest paid over the life of the loan, resulting in long-term savings. It's beneficial for those planning to stay in the home for an extended period, but you need to assess whether paying points aligns with your financial goals and timeline. We need to calculate the break-even point to determine if the upfront cost of points outweighs the long-term savings from the reduced interest rate. Just do the math. So you might ask, just how important is getting the rate low? Example, the difference on a $100,000 loan with different rates and what it does to the payment. The loan amount is $100,000 in all four of these examples. Now you see the amounts here. A full point in rate only changed the payment $67.65 a month. Half a point was $33.84 and a quarter was $17.16. So, you know, you've heard the term date the rate, marry the house. That's absolutely true, because you can always refinance if your rate's a touch high, but what do you think happens to the price of the house when the rates go down? That's right, when rates go down, prices go up. You're not going to be able to refinance that price down. So you're better off to get a better price on the house, paying a little higher rate, because you know that you can always refinance on down the road. You probably also have questions about amortization. Later in this series, we're going to talk about how the amortization of your loan works. In other words, how the interest is applied when you're paying the loan back. But I wanted to touch on it briefly here. As I mentioned earlier, strategy can be so important. So here's some information and an example to show you how the way that you pay your loan can make all the difference. Our example is $100,000 at 5%. Example again, 5% of principal balance means that the principal starts out high, and when you're paying extra interest, your dollar amount is high in the beginning, but as you pay that off, it lowers. So the same 5% of principal is less money with 5% of a smaller principal amount. So it's not so much about the rate that you have as how you pay it back. Because if you're paying it back, or you're getting principal reduction that you can see every single month, it's going to make you be able to pay it off faster. And you can even have, if you're decreasing the principal, the interest that you're paying in each month is less as well. I know I keep saying that interest rate isn't as important as strategy, but it's just so true. Interest rate just shows how the money flows. It isn't reflective of the total cost. The strategy of payment is how you can control the cost. So our conclusion is understanding how mortgage interest rates work is essential to first-time homebuyers. When you're embarking on your homeownership journey, you need a loan officer by your side that can empower you with the knowledge and insights that you need to make informed decisions about your mortgage. Whether you choose to float your rate or lock your rate, prioritize the rate or consider the APR, or opt for fixed or adjustable rate mortgage, our team is here to help you every step of the way. Together, we'll find the right mortgage solution for you that aligns with your financial goals and aspirations of homeownership. Next week, we're going to talk about processing, underwriting, and what happens behind the scenes. Do you like this content? Please like and share, and we would love it if you would subscribe to our channels too. We're on Facebook, Instagram, and YouTube. And you can read more about our team and the mortgage process at mortgagedreamteamok.com. Thank you for watching. Call or text if we can help you or if you have a video suggestion. The Mortgage Dream Team is here to help, and it all begins with a conversation.